webinar. Tonight we're going to be talking about saving and investing. Just to say, it is the second in our webinar series. Last week was our first, where we covered planning and prioritizing your finances. So how you make decisions around prioritizing one area over another. If you'd like to watch that back, or indeed you'd like to watch tonight's back afterwards, so you missed them, they are available on our YouTube channel. So do check them out. Tonight's conversation is going to, as I said, be around saving and investing. So really looking at why you would save, what the best savings habits are, so how you can save, and also where are the best places to put those savings. It's something we get asked about an awful lot. And really the answer is that it's a mixture of different places. You need to have different solutions for different types of savings. Then we'll also have a look at investing. It's a word that often scares a lot of people. Investing is seen as something that's for rich people to do with millions and billions of euros. But in fact, investing is something everybody should really be doing with a portion of their savings, particularly looking at long-term goals over 5 years, 10 years and longer. So savings, okay. Why would you save is something that you might be asking yourself, or how do I save if you're struggling to? Okay, ultimately, it's important that you have a bit of a buffer in life. We talked about this last week a little bit. Ultimately, saving is accumulating wealth. Again, we think about wealth in terms of zeros and hundreds of thousands and millions and billions of euros, but ultimately, everybody's wealth is different, okay? And you start with your savings. Ultimately, you've worked hard for your money and you want to save some of that and keep some of that for yourself, and not just hand it over to other people. So another key part of that, of why you would save, is protecting yourself. So having that buffer there protects you in life from the unforeseen circumstances and the bumps in the road, and means that you're not always living on credit or having to run to credit institutions for help when there are bumps in the road, and things you need help with. Health crises and things like that can often become financial crises very quickly in your life if you're living paycheck to paycheck. The one thing I will say at this point is, if you are struggling to save, it is probably going back one step and looking at budgeting. Okay, it's something there's quite a bit out there on social media and around the ccpc.ie website. It's a consumer protection website, has an awful lot of really good tools as well around budgeting. So if you don't have any savings and you're struggling to do it, you really just, I suppose, need to reassess your expenses and reassess what you're spending your money on, and see where you can make small bits, cutbacks here and there, in order to free up some money that you can then put into a savings account. Ultimately, I believe that good savings are about having good habits, good money habits. The sooner you start, the sooner you start to see the reward. The first thing I would always recommend to anyone is to set up a savings account. I do see a lot of people who try and save with just one. They have one bank account in life. They get paid into it. Everything comes in and out of it, and it's just their current account. Not everybody has the willpower or the discipline to leave a balance sitting in their current account. Okay, so having a savings account where your savings leaves the account and is sitting out of sight and out of mind in a separate account is always, I think, a good idea in terms of helping you with those discipline parts of saving. Also, security feeds into that. Again, having your savings and having particularly where there's big balances, you do not want them sitting in your current account, because in today's world, there's an awful lot of scams going on. There's awful lot of people trying to get their hands on your bank details. And if you have large sums of money sitting in your current account, they are susceptible to you making a mistake somewhere and getting scammed. So having a working balance in your current account and having everything else moved out into a separate savings account is something that can insulate you somewhat from that. It's harder to get instant access to a savings account if you're somebody who's scamming or hacking. The second goal I would suggest after setting up, or the second step after setting up a savings account, is a mantra called pay yourself first. And what that is when it comes to savings is that after you get paid, if it's monthly or weekly, your savings is one of the first things that comes out of the account. So if you have a savings goal of saving 200 euros at the end of every month, if you get paid on the 26th or the 27th of the month, have a direct debit set up for the first of the month that takes the 200 euros out of your current account and into your savings account. That means that you've looked after your savings straight away, and across the rest of the month, the money that's in your current account is essentially there to be spent. And if it is, so be it. You have looked after your savings first. Okay, and you've looked after yourself first in that instance, as opposed to the alternative is to get paid at the end of the month and then start the new month spending that paycheck and waiting to see what's left at the end of the month in order to save. That is generally just leaving it in the lap of the gods a little bit. And again, discipline and willpower and all those things come into it. So if you are struggling with saving, I'd say set up your savings account and then set up a direct debit for after you get paid that moves the savings out into it. And then the third step I would always recommend is setting savings goals. So if you are saving without any clear goal in sight, it can be a little bit, you can get back to the question of why would I bother? Why would I not treat myself this month or go and spend my money on X, Y, or Z? If you have a goal, one of the most motivated we tend to see people when it comes to saving is trying to save for a house deposit. It tends to be, most people would say, when they're most focused and most successful in terms of saving. They have a very real goal, a very real time period in which to do it. And they tend to, in the large, accumulate their deposit and get to their goal and get to moving on to the property ladder. So setting small goals, it doesn't have to be something as big as as having a deposit for a house, but it might be that you're going to have the money saved for your holiday next year instead of maybe taking a loan or putting it on the credit card. It might be that when the car comes to be changed in 3 years' time, you're going to have a big chunk of that, and the loan that you're going to need this time around, or the car finance you're going to need this time around, is going to be greatly reduced. Setting a goal and then trying to move towards that, breaking it down then for how much will I need to save each month in order to get to that goal, is going to help you. One, it's going to help you achieve it, but along the way, it's going to give you motivation. If you can see that you're succeeding and you're moving down the right path, it is going to help you in staying the course and continuing to accumulate your savings. Okay, so one of the things we get most asked is where to put our savings. Okay, I think people in today's world of social media and the internet, there's a lot of information out there, and I think people are well informed that there are good returns to be had on your money in different places, but generally speaking, the places that we typically keep our money don't always seem to provide that. So we often get asked that. I would say the starting point, while banks and credit unions aren't necessarily the best place to go and get a return for your money, they are the best place to start saving your money. The first bit of savings that you put away would be what we'd call a rainy day fund or an emergency fund. We talked about this quite significantly last week. It's your rainy day money for when things go wrong in life, or when you need a bit of help with a bigger purchase, etc. And having that safe and secure and having it accessible are the two most important things. And generally, your banks and your credit unions provide that. That's what they're very good at. So that initial amount of money, we'll say 3 to 6 months of your take-home pay, should be in a bank account or credit union account that is easily accessible. Okay, it can be on the app where you can transfer it immediately, or it could be somewhere that even up to having a 7-day notice account. There are certain savings accounts that will give you a little bit more interest if you fix it. If you have to have a notice period to take it back out. Generally, a 7-day notice period with some of the Irish banks will give you slightly better interest rate while still keeping you safe, secure, and giving you access to your money. You may also end up having a couple of different accounts. There is, I suppose, sense in having more than one savings account with a bank or credit union sometimes. One might be to lock away that 3 to 6 months emergency fund specifically. And then if you have an extra 1,000 to 5,000 euros that you just like as a buffer, but you don't want to keep in your current account because of those security issues I mentioned earlier, having a second easy access, it's going to be a low interest rate account, but that's on your app and is there at the drop of a hat, is absolutely something to consider. Revolut Vaults, N26, all of those kind of provide similar alternatives where the money can be moved to the side a little bit and protected from sitting in your current account, but still be there as and when you need it. The one thing that the banks and the credit unions don't often offer is a good return on your savings. We do see clients coming to us with large amounts of money well in excess of the 3 to 6 months take-home pay, sitting in banks or credit unions for long periods of time. The downside to keeping your money there is that the interest rates tend to be very, very low. And that means that over a period of time, if inflation is running at 2 to 3% every year, that means the prices are going up at 2 to 3%. And whatever you have saved your money to go and buy, your money is worth a little bit less every year. So in an ideal world, you at least want to keep up with inflation with larger amounts of money, larger amounts of savings. So moving them out of the bank and credit union is often something that you then need to look at. State saving schemes are very popular. They are, sorry, we just got a question in there. Should I have my savings set up before a pension? Yes, I would suggest you should. The starting point should be to ultimately cash is king. So your starting point should be your own savings. Okay. Pension is probably the single best savings account you have at your disposal because of tax relief going in, because of tax-free growth. It's actually an investment account as opposed to a savings account, but you'll see a little bit later on they can be interchangeable. But the issue with the pension is that money is locked away till you're 60, generally in your 60s, sometimes in your 50s. They're great pensions, but you should have your own savings in the bank, the credit union first before you think about pension, because ultimately pension is a long-term goal. Having cash savings is something very short-term to protect you in the near future. So I would prioritize it that way around. State savings schemes I was mentioning there. State savings schemes are providing you an alternative to the banks. They are somewhere where you can move your money that still gives you an awful lot of security. So they are savings schemes offered by the Irish state. You are lending your money to the Irish state. So we would like to think that's very secure, and they're not going to stop paying their bills anytime soon. Certainly with the budget surpluses they're running at the moment. But the state savings schemes are quite low interest as well. So they tend to be tax-free. If you save your money in the bank and get an interest on your deposits, or you invest your money, there are taxes due on any sort of income, any money that you make anywhere. State savings schemes are the one exception to that, but then they do know that and they build that into the rate that they're offering you. So very secure. Typically, the state savings schemes are fixed term and longer term, where I think at the moment there's a 10-year state savings scheme and a 6-year, and it pays about 3.5%. So tax-free, 3.5% is not bad, but over 6 years, it's not really a brilliant return if at the moment inflation is running between 2 and 3%, and it's been higher in the last couple of years. So state savings schemes, very secure, but probably still fall into that low interest option for putting deposit money away. Prize bonds would be something similar. They come up. I'm not an expert on them, but I wouldn't be convinced that they'll, over a 10-year period, they'll provide you with a return that's gonna beat inflation. And then the third option you have is with investment accounts. We will touch on this a little bit more, but investment accounts should be part of your savings plan in almost all instances, especially where you're putting money away that you're not going to be using. You don't believe for 5 years plus. So we'll touch on some of the scenarios that you use it in later on, but investment accounts are offered by quite a lot of the institutions in Ireland. They are steady, safe places to put your money. They're not without volatility, but as I said, as we'll see a little bit later on, there is reason to have them within your savings plan. So is there any more questions there? No, I think we're okay. Okay, so when we're dealing with clients and we're looking at their financial picture with them, I will say over saving is a thing, and it's something we see quite regularly. Oh, sorry, just on the questions there, on bank interest rates. What are the best bank interest rates available? Generally speaking, the Irish banks offer better rates if you give them your money for longer periods of time. So the best rates for deposits are fixed term, 1 year, 2 year, 3 year, 5 year fixed term deposits. You are saying that you're going to give them that money for at least 12 months or 2 years or 3 years or however long that fixed rate is, but they do tend to be the best rates that the Irish banks offer. There are online banks now offering quite high interest rates in comparison. So the best bank interest rates are probably running at 2 to 3% maximum. Bank of Ireland and AIB both have a regular saver that if you putting in a regular monthly amount, you do get 3% per annum, which is pretty good. That tends to only last for the first 12 months, though. There are digital banks, N26, Bunk, Trade Republic, who are offering well in advance over 3% on deposits that also have an instant access to them. I would say I'm not an expert in them. Most of them seem to be covered under the deposit guarantee scheme because they're EU-based banks. If you go online and you look at some of the review boards, there's lots of people who, I see them on mortgage applications. They're used quite a lot. There are some reviews of people saying that they are struggling with them because they're struggling to get their money back out, or they're struggling with a deposit, with a transfer that they made into them, and the money hasn't appeared in their account yet. And they're ultimately, with the digital banks, the downside to them tends to be customer service. So when something goes wrong, and if that's I want my money back or where is my money, you don't want to be dealing with a bot or a chat function or anything. You want to deal with a human being on the other end of the phone who's going to fix this for you quickly. That said, I think those people are in the minority. But as I said, I'm far from an expert on those, but they do offer good savings, and they interest return, and they do offer that interest on a weekly or a monthly basis. They pay that into you weekly or monthly. Most of the Irish banks, you're waiting to the end of the year to get your interest. So sorry, I was just moving on then to saying that over saving is a real thing. It is something we see with people, and what I mean by that is continuing to save into a current account or into saving schemes way beyond your 3 to 6 months take-home pay. So large sums of money ending up sitting idle for long periods of time in the banks and the credit unions. As I touched on earlier, the issue with that is inflation is driving prices up by 2 to 3% every year. And if your savings are sitting there earning less than 1%, the value of that money is getting chipped away at all the time. So there is such a thing as over saving, particularly if it's a standard savings account or a current account with large sums of money in it. They should at the very least be moving into some fixed term accounts, some other deposit options that are available, maybe with some banks outside of Ireland as well, where the interest rates offered are higher. Ultimately, if you have sums of money sitting doing nothing year on year on year, they should be invested and not saved, because that is where you're going to get a return that will at least keep up with inflation, and hopefully in a lot of scenarios there is an ability to even beat inflation and actually get your money working harder for you. So investing is a term that often scares people a little bit. The thoughts are of putting your money into something and it being worth double the money in a while, or being worth nothing. It's a double or quits kind of scenario, all or nothing scenarios, where it'll either be brilliant and make you rich, or somebody will run off with your money and you'll be broke. Ultimately, that's not the case. There's plenty of those kind of investments out there, but there are plenty of safe, secure, and steady options to invest your money as well. The first one I'm going to talk about is offered by the life and pensions companies in Ireland. So they would tend to be well-known companies like Zurich, Aviva, Irish Life, New Ireland. They're household names. They've been here a very long time. They've very good credit ratings themselves. They tend to be AA rated or better, which is actually better than the banks generally. They offer investment accounts that are pretty quick and easy to set up. You can put in lump sums, or you can put in regular monthly amounts. if that's depending on if it's savings that are happening right now or money that's already sitting there. And their aim and their goal is to provide a better return than what you would get in the bank. They have looked at the Irish banking landscape for the last 15 years and thought that we can do better than this. We can offer people a better alternative and a way to grow their money. And that's what they've come up with. You do have access to your money once it goes into any of these accounts. So typically you can get your money back in 7 to 10 days. They are designed for medium and long term. So when you are investing, it is not advisable to put money that you think you're going to need in 1 year or even 2 years into an investment, because ultimately that's a very short period of time. And the one thing that is going to give you one of the key things to making an investment successful tends to be the period of time that you can invest for. Because it means that if there's any changes in circumstances, if there's bumps in the road, if that investment doesn't perform brilliantly in the short term, across the medium and long term, you have an opportunity to recover and to make your money back. As I said, they're quick and simple to set up. Once the account is open, you have to pick a fund or a number of funds offered by these companies. This is where a financial advisor would tend to come in and help you pick funds. And the key thing to say is there are fund choices for all risk appetites. So anybody who is quite often, some of the feedback we get is that people don't want to invest because they're very conservative with their money, or people don't want to invest because they're not worried about getting rich. It's not something that's on their radar. As I said, this is about making sure your money holds its value. Okay, so it's not about getting rich quick. It's actually a get rich slowly approach to try and get your money working a little bit harder, so that over the years you're adding, in some instances, 3 or 4% a year. If you're willing to take on a little bit more risk and move into their some of their higher risk funds, that could be 10 to 12% a year. There are options there for all levels of risk. Ultimately, when it comes to risk, I will say there's always risk involved. There's risk involved leaving your money with the bank, because that inflation will eat it away. There's a risk in moving your money into an investment account in terms of volatility and whether your money makes as much interest as you would like it to each year. But there is always risk involved. So just saying I'm risk averse doesn't necessarily solve the issue there. So when it comes to risk with an investment account, okay, typically investments are rated on a scale of 1 to 7. Okay, 1 being the lower, most conservative end of the scale, and 7 being the more adventurous end of the scale. Okay, and as I mentioned earlier, there are fund choices all the way along this risk scale. When we're talking about risk in the investment accounts offered by the life and pensions companies, we're not necessarily talking about risk of losing your money in terms of something running to zero. What the risk is volatility every year. So the risk is that in a good year, your money might go up and perform really well, but in a poor year, it could return and there could be a negative return, and the money in the account will drop below what you invested. Generally speaking, over longer periods of time, over 5 years plus, these accounts, these funds are investing your money into the equity markets, so stocks and shares in the international markets. Over 5 to 10 year periods, those markets rise, and so does the return on your money. It tips back to why you don't use them for 1, 2, 3 years, why you use them for longer term, not longer term savings goals. But as I said, they're rated on a risk of 1 to 7. At the bottom end of that scale, in a fund that's a 2, rated as a 2 or a 3, you might only be getting 2 to 4%, 2 to 5% on your money each year, but in good years. But in bad years, it should only be down by a similar amount. Typically, on markets, 1 in 5 years will be a poor year. 2022 was the most recent year where there was really negative performing markets. We had inflation, we had the war in Ukraine starting, we had gas and oil prices going bananas, and that volatility in the world spooked markets, and it didn't really matter what your money was invested in or where it was invested. If it was in equities and funds, it was going to it was going to be down. In a 2 or a 3, it will have been down a little bit. At the other end of that scale, a 5 or a 6, it might have been down 10, 12, even 15%, depending on the fund manager. So that is what's happening along that scale. In a 2 or a 3, it's a little bit more conservative. The movement up and down will be smaller. As you move towards a 5 and a 6, the good years will be better, but the bad year will be worse as well. So it's what your appetite is and what your ability is to kind of sit through some of those movements. Some people don't mind. They want to chase the big highs, so they don't mind the years where it falls backwards by bigger amounts. Other people want to be really slow and steady, and would prefer to be at the bottom end of that scale. There's 2 funds that are up on the screen there. I'll just talk through very quickly. It might help to explain what's happening a little bit along this scale. So they're funds with Zurich. Zurich are somebody we would use quite a lot for these sorts of investment accounts. And the dynamic fund, which is the top blue line there, is a level 6 risk. So it is an adventurous fund. It is trying to earn really as much as possible through the good years, risking that in the poor year it'll fall quite considerably. And if you take the last 5 years, so from 2019 through, you can see that the returns tend to be 26%, 14%, 24% in 2021. 2022 is a bad year, as I said. This fund fell 18.5%, which is a very big fall. But leaving your money there and not panicking through 2022, in 2023, you saw another very strong year where that fund grew by 21%. So they're very good numbers on the good years, but they're very poor numbers on the bad years. Ultimately, the average return on that dynamic fund over a 10-year period is over 10%. So for the last 10 years, it has done an average of 10% a year. But there's an awful lot of volatility in there, and that sort of up and down is not for everybody. It is at the very adventurous end of the scale. Their cautiously managed fund comes in at a 3 or a 4. I think it's a risk level 4. So it's kind of right in the middle of the road. And you'll see here across the same years, the good years are up about 11%, 7%, 11% again in 2021. 2022 is the bad year. This fund only dropped 12.3% in 2022. And then again, if it remained invested, it grew by 13% in 2023. So you would have made probably most of that loss back in 2023, if not all of it. So what you're seeing there is as we moved back down the scale from the dynamic fund at 6 into the cautiously managed fund at 4, the good years in cautiously managed are not quite, the numbers are not as big, but the poor years aren't either. Ultimately, over a 10-year period, this is going to return a little bit less. Their average return has been about 5.9, so in and around 6% per annum, which is not bad going, but it is just that little bit more conservative than something up at the level 6. As I mentioned, there are options right the way along those funds, and there's something really there for everybody. I'll just see if we have any questions here. Okay, lots of questions. Can I change the risk level in my investment after time? Yes, you can. So once you're in one of these investment accounts, it's important to know, as I said, you have access to your money. Okay, they're designed for longer term, but you do have access to your money straight away. And ultimately, you have the option to change your investment decisions as and when you want. I think you can have up to 5 every year without fund switches every year without charge. After that, I think there's about €20 per charge just to cover the admin costs of moving your money in and out of these funds. So yeah, look, absolutely, we would see sometimes if someone has been at the more adventurous end of that risk rating and had a really good year, or maybe a couple of really good years where they've earned 20% plus on their money for 2 or 3 years, you might look at moving back down the scale and just conserving that gain, and move into a 3 or a 4, so that if there is a bad year, the dip is a little bit smaller. So yeah, you absolutely have the options to change your risk level over time. If you had to choose between either investing or saving now, what would you do? So should I save or should I invest? What I would say is this is similar to the pension question we had earlier about setting up savings or pension first. You should always have your savings in place first before you start investing, either investing in an investment account like we're discussing or in a pension. The reason for that is they are longer term products. You are putting your money away and intending not to use it for as I said, 3, 4, 5 years or even more. You need to have savings in place. If all your money in the world is in an investment and something unexpected comes up, you need to go and cash in that investment in a moment that it might not be particularly good to do that, in terms of it might be a bad year. You've put your money in 2021, you've had a few months of good growth, and then it's fallen backwards for the guts of a year. Okay, if that's all your money in the world and you need to get it back in 2022 because your gas bill has just landed and brought tears to your eyes, you've set yourself up to not quite to fail with your investment, but you've set yourself up where you might end up needing to cash that in a really poor moment. If you have your savings in place first, it insulates you somewhat from the need to run off and cash in that investment at a bad time. As you can see from the numbers there, if you were able to sit it out in 2022 because you had cash savings on hand, through 2023, the money that was invested was going to grow considerably, and you would make back any loss that happened in 2022. So it is very important, and always the first step, that before you start investing your money, you put your savings in place. So that would be your emergency fund. And then the next thing being any short-term savings that you think you might need in 1 or 2 years, holidays, changing the car, things like that. Get that buffer in place before you start investing. Okay, so obviously with these, one of the things we will get asked about a lot as well is charges and fees. So none of these companies will do this entirely free of charge. The banks tend to charge us sometimes directly and sometimes by way of just the interest rate that they're offering. They do tend to be charges with these. What I would say is there's no upfront costs and no cost to setting it up. So neither Zurich nor a broker would tend to charge you upfront to do that. 100% of your money goes and gets invested. And typically the charges are about 1.5% a year for administering and managing that investment. So when you are in one of these funds that we're mentioning here, so we'll say the Dynamic Fund. The Dynamic Fund is managed by Zurich, who are based in BlackRock. There's a fund manager in there whose job it is to manage. There's about probably 2 to 3 billion euros of Irish savers' money sitting in the Dynamic Fund. And it's their job to try and get that return for a level 6, so of kind of 10 to 15% a year. It's their job to invest that money to try and get that return. So there are fees there for that person doing their job, and then there's fees for on something like a regular saver where they're taking a direct debit from your account. There's administration fees there as well. So that covers it. There aren't fees to take out your money in the first 3 years. There does tend to be early encashment fees. So because these are designed for the long term, if you look to take your money back in year 1, there tends to be a 3% charge. Year 2, a 2% charge, and year 3, a 1% charge. After that, you're free to take your money back whenever you want without any charges coming back out. There's no encashment fees. Those 3, 2, 1% are there to, I think, to dissuade people from throwing in money that they really know that they're going to take back in 12 or 18 months' time. Something we get asked on these accounts is people who are saving for a house deposit often would love to get a bit more of a return on what's sometimes the biggest amount of money that they've ever had. If you are intending to buy a house in 1, 2, or 3 years' time, this is not the answer. You need to look at the best savings account you can use for that, because ultimately an investment can be too volatile to use over such a short period of time. We have some examples here of where you'd use that. If you're buying a house in 6, 7, 8 years' time, and if you're a little bit younger or your journey to getting a house is a little bit further away, absolutely, saving bits and pieces, saving regularly into an investment account can be a really nice way of doing it. But if it's a short-term goal in the next 2 to 3, 4 years, this isn't the place for your money. Okay. Just a question in there on what is the investment risk? Is there a risk of losing all my money? So typically this isn't in one of these funds. So as I said, in an effort to de-risk your investments, what you're often looking to do is, 1, invest for long periods of time. Okay, time is generally your friend. And 2, it's it's also about diversifying your investment. Okay, so if you put all your eggs in one basket, there's a chance that things can go wrong. What you're getting with one of these funds, the dynamic fund, again, to look at it, or the cautiously managed, typically are investing your money across 400 to 600 different companies and bonds and investment products. So you're getting a really, really wide range of investments. You're diversifying your money across it. You probably will never have enough money to invest in 600 different things yourself, but that's the benefit of pooling your money through one of these companies. As I said, with 2 to 3 billion euros in one of these funds alone. Zurich Down and BlackRock have about 30 billion of Irish savers' money in their hands. And so the risk of Zurich turning around and saying that we've lost all your money, they're AA rated institution, so their credit rating is very, very strong. They're not going to go bust. And the nature of these investment accounts is to spread your money for steady growth year on year, as opposed to being in one or two things that could go really well or really badly. So there's always a risk that you could lose a little bit of money, but generally speaking, if you're talking about losing everything, it's not really a scenario with these sorts of investment accounts. Okay, structured products. It's something I'm going to touch on. It's a little bit more niche, is what I would say. Typically, these are for people with lump sums to invest. And if you had 10 to 20,000 euros, and that was, apart from your savings, that was all the money that you had in the world to invest, this probably wouldn't be our first choice with it. Something like those investment accounts are a great starting place to start growing your long-term savings. But they are something that is very popular. And that's often because they provide quite a lot of protection for your capital. So typically 90 to 100% of the money that you invest in a structured product is protected and you can get it back. And the investment performance can depend on markets, but you can't ultimately lose the money that you put in. You do need a decent chunk of money to invest in a structured product, in a structured bond. Typically that's 10,000 euros to 25,000 euros as a minimum. The terms tend to be 3, 4, or 5 years. There are some shorter term ones and there are some longer term ones, but typically it's 3, 4, 5 years. And as I said, one of the real attractiveness of these is that there is security there. So people who are risk averse, people who are looking for something that's nice and secure, there's protection for the capital you put in, usually to the tune of 90 to 100%. They can be complicated as to exactly what you're invested in. Anyone we are recommending this to, we of course can give the detail to, but without getting bogged down it this evening, the return that you can get typically depends on the stock market returns in the given period. There might be an index like the Euro Stock 600, which are the biggest 600 biggest companies in Europe. The S&P 500, the biggest 500 companies in the US. They're stock market indexes, and typically it depends on the performance of those over the given years, and will get a certain amount of that performance for your investment. Can I change just okay? So lastly, before we wrap up, okay, I don't want to keep people any longer this evening, but some of the most common reasons to invest, I'm just going to touch on very briefly, okay? As I said earlier, people are often like, when should I do it? There's never one or two opportune moments, but what the most common reasons we see people using investment accounts and using them successfully and well and being delighted are, one, for younger people, it tends to be when you start your first job or your first few years in your job. Okay, sometimes for most people that's the biggest pay rise they're ever going to get, is their first job. So the opportunity to start good savings habits then is what you want to do. If you're putting a few hundred euros into a bank savings account to have some cash savings, and you could still save another 100, 200, 300 euros a month into an investment account, then it's something that you can put away for a long-term goal, like starting your own business or saving deposit for a house. I was lucky enough that when I was in one of my first jobs in my mid-20s, my father was a financial advisor and had me set up in an investment account with about 100 to 150 euros a month going in. But by the time I was in my mid-30s and I was looking to buy a house, the job of saving my house deposit was largely done. both from the money that I was putting away that was out of mind and out of sight, and also the return that money had gotten in the investment account. So that's typically something that we see is somebody looking to, again, put money away out of mind and out of sight and out of mind for a long period of time, doing it in their 20s or early 30s for a goal that's maybe 5, 8, 10 years away. When it comes to families using these, it's often to start saving for using them as child savers, to start saving for education costs at second level or third level, or just generally putting a nest egg aside for their child or children. They're fantastic for this, again, because the money that you're putting aside every month or every few months, specifically for something like that, tends to be a savings goal that is 5 years away or 10 years away or 20 years away, depending on how young you start. But they are fantastic. There are investment accounts that you can use and keep the money in your own name for things like investment, for things like education costs. There are also ones that can be done in trust in the child's name. If you're looking to gift money to your children over time to avoid inheritance tax, you can gift up to €3,000 a year. Any person can gift another person up to €3,000 a year tax-free. So they can be done in trust for grandparents, parents, godparents, to gift money to children over 5, 10, 15, 20 years. They're very, very popular and very, very effective. And then lastly, often we see people a little bit later in life in their 50s and their 60s, when maybe their family are a little bit older. Sometimes they're empty nesters, and often there's lump sums here that come from maybe selling a business. Inheritance is now a fairly significant factor in most people's lives. It can be a lump sum bigger than anything you've ever had in your bank account or in your life before, and all of a sudden you inherit thousands of euros, and you're not unsure what to do. Something like an investment account is a great way to put it aside, get some good growth on it, and yet still have it there for when you decide what you want to do with it, and when you want to do that. So they're just a couple of, as I said, the most common themes that we see with people coming in and starting to use investment accounts across various age groups. So look, we're nearly 8:45, so I've done a lot of talking. Thank you all for tuning in. I hope you found it informative. As always, if you do have questions, feel free to email us or get in contact. If you'd like to talk about savings plans or you'd like to talk about investment accounts, please do reach out. We'd be delighted to help you. And if you'd like to watch back any of this evening's content, will be available on YouTube straight afterwards. Next week, we are going to look at understanding your pension. So 8 o'clock next Wednesday, it's understanding your pension. That is for people who maybe don't have a pension and need to understand why they need one. Or also we are going to touch on people who have pensions and maybe just get a piece of paper in the post every year from the pension company, but have no idea what's going on. We're going to try and break it down and explain to you exactly what's going on with your pension.